Hi guys, welcome to another video on Great Life Project channel. In this video today, I'm going to be sharing with you 8 ways to start investing in 2022. As we know, 2021 is almost over, so it is time to start planning ahead for 2022. So in this video, I'll be sharing with you 8 solid ways in order to start investing from 2022. If you are new to this channel, please kindly subscribe to this channel. On this channel, we share information on personal finance, on how to make money online, and on motivation. So let's get into it. We all know that it's not secret that the recent pandemic was more instrumental in pointing out our financial shortcomings than we would like to admit. So, with decreasing number of cases and increasing vaccinated numbers, our optimistic selves definitely resonate with quotes, "The only way from here is up." Additionally, with the International Monetary Fund stating that it predicts India's economic growth in 2022 to be 8.5%, the question at hand is, how do we make up for what we have lost during the pandemic? Taking from recent pandemic lessons, investing is clearly the need of the hour, not only to take your savings a step further, but also to offer your reserve a decent chance at beating inflation. As we know, recently, the prices of goods and services have gone up astronomically, and then we need to find a way in which our investment can beat the rate of inflation. And what better way to start than to start early? However, investing is best leveraged when done in a disciplined but also systematic manner. And if you are wondering how it's done, here is all you need to know about planning your investment ahead of 2022. The number one way I'll be sharing with you here among the 8 ways to start investing in 2022 is put down your financial goals. For instance, we all got a dream or dreams to chase. For instance, some of us wants to be financially free. Some of us want to be out of debt. Some of us wants to buy a home maybe in 2022 or 2023. Or even you want to start a new business. You want to start building that capital so that you can start a business maybe in 2022 or even in 2023. So how do you do that? You have to start stating your financial goals, and also you have to be clear about it. Know what your goals may be similar. Know that your goals may be similar but will not be the same as another person's. So someone else may also need to buy a car, but they may not have to buy the same specific brand at the same time or for the same reason. Your goals are unique to you and form the stepping stones to all you want to achieve. Additionally, if you got more than one goal, write them down and then rearrange them according to priority. Keep in mind that you also need to be realistic about it. That is, are they achievable? How do you want? What are the systematic approach that you want to take to make them realistic or to achieve those goals? It may also help to first aim for goals that could be an asset over others that fall in the liability category. So the second way is analyze your finances. Analyze your finances. To know how you're going to get to where you are headed to, you need to fully understand where you are. This way you can map out the distance that lies between your present circumstances and the future that you wish to create. In order to know how much you can invest to achieve the goals that you have set for yourself, it's important to consider your financial obligation. A realistic approach is understanding that if you, for instance, earn about $10,000 a month, and then, for instance, you pay about $2,500 on rent, and then you invest $2,000 monthly, as it may interfere with your electricity, grocery, or lifestyle bills. Subtract your financial obligations from your regular income, and you'll be left with a liquid number that can be used to invest in the future. At times, it's even more important to know how much you want to save. For instance, do you want to save 10% of your income? Do you want to save 15 or 20%? It's always advisable that you take out the percentage you want to save for future investment first before you start spending. Otherwise, you will spend and then you'll be forced to save whatever remains, and that might not be sufficient for you to achieve your long-term goals. So the third point, or the third way that I want to share with you, is consider the timeline for your goal. Now that you know that you are aiming for, now that you know what you are aiming for, and the capital you have at hand to achieve those goals, for instance, think about how long it will take you to achieve those goals. Remember to be realistic. Number one, that's very important. While you may want to buy your first home in the next 2 years, you have to consider the money and the time you need to devote to achieving this goal. Number four is think about your risk appetite. Think about your risk appetite is a very, very important point. At this point, investment opportunities with a higher risk offer you a chance at higher returns, while risk is mostly a part of well-balanced portfolio. It varies in its intensity as per your choice. You choose how much of a risk you want to take. So having an idea of how much risk you can take is a good way to establish your limitations and scope before you make an investment decision based on risk. Remember, the risk you take increases the factors like higher income, lower financial obligations, fewer dependents, being young, and other factors. Similarly, your risk appetite reduces with having debt, more financial obligations than 50% of your earnings, being closer to retirement, unemployment, and other such factors coming into play. So the fifth one that I'm going to share with you is even out risk with diversification. You cannot afford to put all your eggs in one basket. So while financial instruments may be more convenient to keep a track of, give your money more chances to outlive and overcome risk, this avoids limiting your capital growth to a single or few investment instruments. While a fixed deposit may assure you of the returns, remember that the interest rate that it currently offers may not stand the chance against inflation, especially at this current time that we are in, which defeats the purpose of investing in the first place. Because, for instance, if the rate of return that you're going to earn from an investment is lower than the current rate of inflation, for instance, if you're going to just earn 4%, for instance, or 3% interest rate on your investment, and the current, for instance, rate of inflation is maybe 5-6%, it doesn't make any sense. So your rate of return must be higher than the current rate of inflation. So that's very important to know. Also, remember that just like the sudden slump in the economic growth during the pandemic, the environment of your investment may not always be as healthy. To follow the saying, precaution is better than cure, is to manage your investment as per your portfolio's evolving need and resources. To follow the saying, precaution is better than cure, is to manage your investment as per your portfolio's evolving needs and resources by being prepared to handle any possible oncoming slump of any kind. And the sixth one that I'm going to share with you in this video is avoid getting carried away. Avoid getting carried away. In as much as you are planning to achieve maybe both your short-term and your long-term goals, you need to be focused. Keep in mind that emotion finds its way into most of our life's decisions, and while it can be helpful, it can also impair your ability to think logically. The financial lack brought on by the pandemic, the increased use of digital transaction over cash, the unemployment and other factors have increased the number of investment scams that many people fall prey to and often. However, seeing the glass as half full doesn't always mean investing in any and every avenue or opportunity that promises to offer you lucrative returns on your invested amount. First of all, it's very important that you do your research before investing your hard-earned money into any opportunity that may seem to be too good to be true. Remember, keep your emotions in check while monitoring existing investment, if any. What may seem like a short-term loss, what may seem like a short-term loss could prove to be a wealth-growing opportunity for your portfolio. The seventh one I'm going to share with you in this video is the seventh way to start investing in 2022 is ensure liquidity as you choose investment. Ensure liquidity as you choose investment. One of the pandemic's biggest lessons was understanding the need for easy liquidation of investment. While you may have an emergency reserve set aside, it is important to ensure that you are not paying penalties for early redemption of your investment if you find yourself in a situation that demands it. Additionally, having a corpus of money locked in and one that takes more days than you can afford to be liquidated, like real estate, can defeat the purpose of investing in order to have the fiscal resources you need for unthought of emergencies. That is very important. So this takes us to the eighth way to start investing in 2022. So look forward to 2022, but be prepared. Look forward to 2022, but be prepared. After knowing all these 7 points that we've went through in this video, the next step is understanding the opportunities at hand. As situation stabilizes, investing in just maybe, for instance, electric vehicles or even electric vehicle companies or pharma care companies and expecting them to only boom may not always be recommendable. May not always be recommendable. With the recovery from the slump of the last 2 years, manufacturing and logistic companies that are making their way back seems to be coming back into the limelight as investment opportunities. For instance, made in India companies also seems to be gaining more attention and traction. Furthermore, with inflation rates set to resume the pace from pre-pandemic times, equity may offer the strongest chance there is. Not only get a head start on, but also beat inflation. It could also help to consider that well-established and well-managed bigger companies may offer more stability in bouncing back from the pandemic lows, painting large and mid-cap companies to be attractive investment opportunities. Additionally, if you are looking to reduce your capital exposure to just one economy and find yourself interested, maybe for instance in the US market and its offerings, remember to look beyond the popular FANG option. With bigger returns in the past, there could be slower growth in the future, especially given the recent changes in scrutiny field environment created for these companies. Keeping an eye out for a chance to invest in an attractive value company with a focus on US exchange traded funds could also offer, avoiding the negative effect that the rupee's depreciation inflicts on your investment. Finally, looking for opportunities that offer higher returns than industry averages can offer your portfolio a good boost. However, remember that research is the core of good investment planning and strategies, and should play an essential role in determining how you invest in 2022, especially given the number of instruments available that can only rise from the current standpoint. Informed investment decisions are definitely better ones. So these are the 8 ways to start investing in 2022 that we've gone through in this video. If you like those 8 ways I've shared with you starting investing in 2022, please kindly smash the like button so that the YouTube algorithm recognizes that and share this video with a lot of other people. Subscribe to this channel if you have not done so. Thanks for watching, and I will see you next time.